I think is we're headed for a recession that's very bullish for safe haven assets, which includes gold and silver. And if the U.S. goes into recession and the Fed reverses before the ECB does, that is also bearish dollar, bullish alternatives. That doesn't have to happen, but if it does, it gives us a good tailwind. So quite clearly, gold and silver. And then the only thing about silver is, it's not that I'm not bullish on silver, but I just want people to understand that silver characteristically in a bull market lags gold anyway, and then catches up at the end. And all I'm saying is it may do that even more so this time because it has this stronger than ever industrial component.
Lobo Tiggre, the founder and CEO of Lewis James LLC, recently appeared at Investing News, where he shared his insights on the potential profitability of gold and silver stocks. He emphasized the importance of investors paying attention to market prices while cautioning against allowing them to dictate their decision-making process entirely. With a strong emphasis on the historical significance of gold and silver, Tiggre highlights their role as a reliable hedge against economic uncertainties. These metals have proven their resilience over time, maintaining their value even during turbulent market conditions. Tiggre's confidence in their long-term potential is evident as he shares that he currently includes gold and silver in his personal investment portfolio, further substantiating his belief in their growth prospects. During the interview, Tiggre mentioned that while gold ETFs are popular for their simplicity, he thinks investing in gold and silver stocks can be better. In simple terms, he believes that investing in gold and silver stocks can give you a chance to make more money compared to just buying gold ETFs. We will now bring you clips from Lobo Tiggre's interview with Investing News. But wait, there's more. To stay updated with all our future uploads, make sure to hit that subscribe button and turn on post notifications. Thank you, and enjoy the video.
Silver maybe lags a little because of its industrial side, but it's still a monetary metal, and gold and silver are in my shopping basket right now. And if I look at it again, and my basis for speculation hasn't changed, then I have to set aside that price. And however angsty it makes me feel, and I'm not saying I'm a robot and I don't feel these things, I do. It's annoying, but I don't let that make my decision. And, I don't want to come across as condescending or insulting, but, you kind of have to buck up on these things. If you can't handle the heat, you really shouldn't be a speculator. Maybe just buy a gold ETF or something and ride the metal itself and don't worry about the stocks. But if you do that, maybe you'll sleep better. Maybe that's better for you. But if you want to make money, you will be leaving a lot of money on the table because the leverage that the stocks offer to the underlying commodities is legendary. Unless the entire world has changed when we didn't look, Charlotte, I do think that we will see payday. And I just think it doesn't make sense to be impatient. And if anything, if we have capitulation because people are just so disgusted with the stocks, gold's up, my stocks are down, and people just decide to sell, or the fair weather friends, the momentum chasers, just get out. Anybody who bought when gold hit that nominal all-time high, and then now they're disappointed because it's corrected, I think the disciplined speculator will take shares off those weaker hands, and especially if you get it, if you're with the program, but you're late to it, I think at times like this are a godsend when the actual value case is higher, plus or minus $2,000, that's a terrific gold price. And if the stocks are on sale because of sentiment, market sentiment, that's absolutely an opportunity in my view, Charlotte. What I have found is actually that the long-standing relationship between real rates and gold seems to have come unglued, and not just today or in the current chaos, but over the recent years. And there was a stronger case to be made back in the 70s and 80s in that big gold cycle. So I understand why my mentors taught me this. And then you had this nuclear winter of, the 90s and the aughts, and nothing changed. But actually, since then, a lot seems to have changed.
Tiggre believes that real rates are an important factor to consider when investing in gold. Real rates are the difference between nominal interest rates and inflation. When real rates are positive, it means that the interest you earn on your money is more than the rate of inflation. This makes it more attractive to invest in cash or other assets that offer a higher return, such as stocks or bonds. As a result, demand for gold tends to decline when real rates are positive. However, Tiggre has found that this relationship does not always hold true. In some cases, gold prices have actually increased when real rates have turned positive. This is because gold is seen as a safe haven asset, and investors may turn to gold when they are worried about the economy or the stock market. Tiggre believes that this is because gold is not subject to inflation. When inflation rises, the value of cash and other assets declines. However, the value of gold remains relatively stable. This makes gold an attractive investment for investors who are looking to protect their wealth from inflation. Let's get back to the interview.
First, I should say that when we last spoke, I was saying, the dollar had had a good run. There was reason to believe that the dollar would go down. And at the time, gold was still seemingly trading primarily off the DXY, the dollar index. And that pretty much worked out. And we went on to these highs and we stayed up over $2,000. But that has become unraveled. And, there are days where gold trades like a Rorschach image to gold and the DXY completely. And there's days where gold and the dollar are going up together. And it's not because there's a new war or something, it's something else. There's days where it really seems like the 10-year, the US 10-year benchmark rate is really what's driving gold. And days they seem just like all three will go up at once sometimes. So I'm not helping your audience here. I'm not clarifying anything here, but maybe that's actually a good starting point. Whatever you think whatever you're sure explains everything. This is a time to not be quite so arrogant about that. Take a step back, take a deep breath, at least in the near term. I mean, bigger picture, yes, all the money printing, recession, all that stuff. But right now, the whole market has gotten quite chaotic. So this one thing that we were reassured for so long meant we didn't have to worry about gold. Suddenly, that accepted signal says, well, it's time to worry about gold. So I went to look at it. And I found a lot of noise. I was trying to look at real rates. They've gone positive. So what's the correlation look like? And really this year, since real rates have been climbing, guess what? Gold was climbing at the same time. And until just the last couple of weeks when, gold went back, pulled back from 2000, we had real rates and gold going up together. So of course I have to say, well, what's that? They're not supposed to do that. They're not supposed to go up together. They're supposed to be opposite, X on the chart. So I started looking farther back, and the noisier the real rates looked, they didn't seem to be inversely correlated. So I pulled back and looked at the big picture. The biggest relevant picture is August of 1971 to present, because that's when gold was freed to trade on the open markets, or you could look at it that way, or that's when the dollar became a worthless abstraction. But anyway, and then I looked at it, and just by I was looking at different real rates, and then just by comparison, what's the difference between the nominal rates? And I started looking, and the nominal charts looked better or more explanatory in many cases. Even the most exciting ones with the strongest cases going forward, not in front of the recession. I want to see the recession do its worst, or the worst be priced in. When the recession denying needs to go away before those commodities really get whacked, and that's when I'll be looking to buy. As a contrarian, as a bottom feeder, I want to see capitulation on the broader markets, because I think that will whack everything industrial, with the one exception being, of course, uranium, which is baseload power. Unlike copper or oil, uranium is having a great year. And even better, we were talking about, gold bugs maybe not being in capitulation yet, but seeming close, pulling their hair up. I think it's with uranium bugs, they're there. I'm hearing from uranium bugs left and right, and I'm sick of this. The metal is going up, and my stocks keep going down, and all that. I see that as an opportunity to anybody with the guts to be a contrarian.
Looking to the future, the outlook for gold remains positive. As economic uncertainties persist and market volatility continues, gold is expected to maintain its status as a safe haven asset. Furthermore, as central banks around the world continue their monetary policies, which include low interest rates and quantitative easing measures, the potential for inflation rises. In such an environment, gold historically tends to perform well as an inflation hedge. This could further drive the demand for gold in the coming years. So how do you see gold playing a role in your investment strategy for the future? Please share your comments and observations in the comments section below. Additionally, if you found this video informative, Don't forget to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.